do you think valuations are hanging right now? Are they too high? And what's next?
Yeah, thanks, Emily. Thanks so much for having me on. Are we talking public or private company valuations?
Both.
Both. So look, I mean, anybody watching the markets has obviously seen that, especially in the software internet world, public valuations have come down, fairly dramatically. You wouldn't know it in the indices, given just how much of the indices is weighted towards the large cap companies like Apple and Microsoft and Facebook and Google and stuff like that. But underneath those, companies like Snowflake or Toast or Okta or these companies have come down hugely dramatically. And public companies tend to lead private company valuations. And I think you will start to see, and we're starting to see private company valuations decline. You'd had a lot of crossover hedge funds that had been entered the space over the last 5 years, and we're looking at some large deals right now that 6 months ago it would have been kind of swarmed. These are $50-60 million revenue companies that would have been swarmed by crossover public investors, and I think in this deal there's like one looking at it. So it should be like a good time to invest. Depressed valuations and less competition should be a good time to deploy money.
Right. So how do you plan to put this new $1.95 billion to work?
Yeah, so same way we have been for many, many years. We deployed our last fund, a $950 million fund, in like 15 months. And so, we want this fund to take, 2.5 to 3 years, 2.5 years, 3 to 3 years to invest. And so continuing to do what we do. We're primarily Western European, North American investors. We've done some stuff in Asia over the years, companies like Ant or ByteDance or Alibaba Group we were early investors in, but primarily US and Western European and Israeli-based software and internet companies and fintech companies.
So, when you look at valuations, are you changing your own bar in terms of what is reasonable? And do you think more broadly we're just going to see a lot of air get let out of the balloon?
Yeah, so look, since our biggest mistakes, to be clear, over the last 5 to 10 years was not predicting multiple expansion. Had we would have made our LPs billions of dollars more than we've made. We've done really well, but we would have made a lot more. Look, the way we make investments is we build 5-year models, and this is no different today than it was 5 years ago. And we slap a reasonable, earnings or revenue multiple on them and discount back. There were a bunch of deals getting done over the last 12, starting there were a bunch of deals that got done in 2021 that we could not figure out how people were underwriting these valuations because when we stuck in our exit multiples, which we thought were reasonable based on historical averages, we just couldn't get there at all. And it's just we kind of use a historical average multiple to exit stuff, and we'll continue to do that. And so I think what's interesting is that in Fund 5, we just raised Fund 6, we'd only done 1 or 2 deals in the Bay Area, and a lot of our deals were just in random other places around the world. Ann Arbor, Michigan was one of our biggest investments in Fund 5. We just thought you got better valuations there. It's not because we don't like stuff on the coast. I think in Fund 6, you will see us do more stuff on the coasts just because I think valuations are getting to be more reasonable.
Now, online payments company Fast just closed shop yesterday, saying they simply ran out of money. Are we going to see this happen more often?
I'm sure you will. Yes, I'm sure you will. We have this one criteria that is super important to us called capital efficiency. And it's like our version of return on equity. It's like the very dumb person in our views return on equity because it's not based in scientific fact. But what it is are your revenues today, are your recurring revenues today, or your annual recurring revenue, ARR, greater or equal to the amount of money you've burned since day one of the business? Now, maybe you've raised a bunch of money, but if it's sitting in the bank, don't blame the entrepreneur. So in other words, the world is littered with $30 million revenue companies growing fast that have burned $100 million to get there. But we want to find the companies that are $30 million of revenue that have burned like $10 million to get there, because those are companies that are just not going to like fall off a cliff if times get tough. They also just if you can grow fast and not burn much money, you've got a good business. So it's just like a simple, like a check that in every deal that we invest in, we rate it. Is it capital efficient or not? Now, not all the companies we've invested in are, but the vast majority are. It just keeps.
What are your thoughts? What are your thoughts on the crypto market? Where do you see hype and where do you see opportunity?
I think it's a giant bubble. But to be completely fair, we have not. We've looked at some of this stuff in crypto, more around like the picks and shovels businesses, like a business called Chain Analysis we looked at early. We're not investors. Benchmark was an early investor.
So where do you see the giant bubble?
I don't know if the right price for Bitcoin is 60,000, 70,000, 20,000, or 500. I just know this. When I have a lot of random friends who know nothing about investing telling me it's easy to make money in crypto, like that smells bubble to me. I also, one of my buddies who's been a really early investor in crypto and made a lot of money on it, and somebody I guess I should have listened to, said he's convinced that like every fraudster in the world is now in the crypto world. Like this stuff is real. And by the way, if you believe that like crypto is the next like internet, then you might see a drawdown of 90% or 80%. But this stuff is real. Like I just think a lot of this stuff is overhyped and like is not justified at all in fundamental investing. But I do think it's real. I do think it's here to stay. One really interesting thing about crypto is it's it's really volatile. So I was reading recently, when I saw that like Tesla was enabling you at one point to be able to like pay for Teslas in Bitcoin, I thought that was like super cool. You could take you could take a currency and use it for an exchange of goods or services. The problem is that like, and the reason they got rid of it and why I think you haven't seen Amazon and other big retailers start to accept it is these currencies are just too volatile. Like I think there's been like something like 10 days where Bitcoin has moved like 10% in a day. Like the biggest US dollar move ever, like a US dollar euro move ever, has been like 1.5%, and it's happened like 5 times. So these things are just too volatile right now. But I do think they're real.